if you look at the volume, it seems to me that that's exactly what we've been seeing on this stair step up from $2,000. The central banks, when gold goes on sale, they buy the dip. And that, the central bank buying by itself is a game changer. But to have some collection of entities with such deep pockets willing to step in and buy the dips, that might be the very thing we'll find out in the future. But that might be the very thing that stopped the slide this time. There was major panic a week ago, but somebody stepped in to buy the dip. And I don't think it was George Soros or even Druckenmiller or Gundlach or the more pro gold types. I think we'll find out in the future with central banks. Nobody goes broke taking profits. I said this on the way up. Rick Rule famously, rocked the boat by saying recently that he sold 80% of his physical silver. Okay, even I'm not that Darth Silver. I don't sell bullion at all. That's my savings. Unless I need to dip into savings for, an emergency or a once in a lifetime opportunity. I only buy. I don't sell. I don't trade them. I don't invest in bullion. That's my savings. But the stocks, you betcha, I took a lot of profits recently on the way up, not because I knew this was going to happen, not because I think it's 2011, just because I had them. They're profits. That's what they're for. And you can rotate them into other investments. And then people say, oh, I like gold and silver. Anything else I don't like. Well, what else would I do? Well, I just paid off my mortgage, Vladislav. I went to the bank and I gave them the check. And the person, they didn't even know what to do because nobody does that. So they had to bring out the 3-ring binder to find out what to do. They took my money, and I looked the bank manager in the eye and I said, "This is freedom." And she smiled, and everybody behind the counter, they all grinned like they understood, right? So you're not a trader to gold or silver. If you take some profits on the way up, we had a pretty sharp correction that silver, as you and I speak, is back up to 80, which is, okay, it's not a real all-time high adjusted for CPI, but it's still a very high price relative to recent years, and certainly relative to the price assumption used for building today's silver mines. In other words, it's a fantastic price. Like this is the silver miners and the gold miners are literally making money, right? If gold and silver are real money, they are literally making money at this point. And their margin expansion has been substantial, which we should see in earnings coming up. And one of my favorite things about this is actually very Warren Buffetty. Right? There's a moat here. There's a huge, wide, and deep moat around the miners. If you've got a profitable mine now, the best case scenario is your competitors have a shovel-ready project that's going to take a year, 2, 3 years to build. And they have to have the permits, they have to have the financing arranged. These things are starting to happen. But mining is a space where high prices, yes, they cure high prices, but not like that. Can't spin on a dime and give you change. It takes time. And right now, these guys are printing cash and their competition is at least a year behind. What an enviable position that is.
Lobo Tigre says the silver crash was just a healthy correction. Nothing goes straight up forever. His proof? He sold into strength and paid off his entire mortgage. Bank tellers didn't even know what to do. Central banks bought the dip. Miners have a massive moat and are printing cash. He's rotating profits into oil, copper, and uranium.
Let's say we are looking at a 2012 moment. That a couple of weeks ago, that was the top. We're not going to see higher prices for years to come, and we're headed for a bear market. If that's true, if you bought gold in 2011, you top tick that market and you top tick silver in that market, you're up more than 2x, 2.5x from those prices today. Okay, it took 15 years, but and I'm not dismissing that, but I'm saying that's not the end of the world. Like if you're a long-term fundamental investor here, and of course, it took 15 years to get back to this double. It took a little bit less than that to get hold again. And if you were a fundamentalist investor and you saw that your thesis hadn't changed and you averaged down and if you just, very few people bought at the very top in 2011. I'm trying to present the worst case scenario here, Vladislav. So like if you top tick that puppy, 2011, you're pulling your hair out for the next 5 years, but you believed in why you bought and you average down, then you would not just be, 2x, you'd be 3x, maybe even 4x, depending on where you bought. But my impression is that the marching orders are look, we got to diversify. We want you to shift 10 to 10% gold. Like Morgan Stanley says, we want 10% gold in our reserves, and we want you to accumulate until you hit 10%. So I could see that happening, and we don't know what those goals are, but at some point, if you're the Bank of Kyrgyzstan or whatever, and you get to that allocation where you were told, by your political masters, accumulate this much gold, and you achieve that goal, well, then I can see that you might stop buying. But I don't think the price has anything to do with that. They will buy until they achieve whatever diversification goals they have. And I think in the case of particularly Russia and China, and maybe some others, but particularly in those cases, I don't know that there's any stop to how much they want to harden their assets and diversify out of the dollar. So I should just say real quick, I saw reports that Russia was selling some of their gold recently. I saw counter reports that they were selling it to themselves, and it wasn't really how it looked. But like, just think about that though. If Russia was selling gold, and the worst it could do is knock gold from 5,600 down to 5,000, like, that is huge. That tells us something really solid about this market. So this is great. We get it. I'm sure the audience understands this. They don't need to tell me how margin expansion is beneficial for these equities. But let's say gold isn't done correcting for now. Let's say, it drops all the way down to 4,000, and silver drops all the way down to 50. Oh, woe is me. Whatever will we do? Well, the miners will still be making money hand over fist, but the market will puke. Like, if the metals move that much, it's unfair, it's unjust, maybe even illogical. But the leverage to the downside is always more than the leverage to the upside, and the stocks are leveraged to the underlying commodities. So I have no doubt in my mind that even the very best in the space, if there's another big downdraft, another $500 down gold day or something like that, or 10% drop in silver in a day, I have no question that the stocks will get hammered. Like in 2011, we really hadn't seen anything like that. Like, we were picking ourselves up off of the floor in 2001. And the only real reference, there were some minor bull rallies in the 80s and 90s, but really the main reference was 1980. So when we had that peak in 2011, a lot of people were thinking that's it. It's going to go down, like back down to $200 an ounce, right? Or less or something. They didn't believe that peak was sustainable. That just turned out to be a foothill compared to what we've seen now. So I think this is extremely bullish, actually. And people know that. Like, before 2011, it had been generations in finance since anybody saw gold do anything interesting. Like, people just didn't believe it. And now, it's very different. Gold has gone mainstream. $5,000 gold is telling us something. So completely aside from the issue of what I'm looking to speculate on with my portfolio and my money, I would like to remind everybody that bullion is not a speculation. It's not an investment. Like our friend Rick Rule says, I don't buy gold because I think it's going to $10,000. I buy it because I'm afraid it's going to $10,000. And this is not new, I know, but if you don't have a decent allocation, if you don't have enough bullion to cover, say, your living expenses for a year or two, I think that is something to be remedied. It's insurance, right? And the time to buy insurance is before the fire, not after. And after the fire, you don't care what the price was when you bought the insurance. You just wanted the insurance. So I just want to remind the audience of these fundamentals, why we're here, what these things really are. And, the price isn't the point. The point is having the insurance, that you can hold it in your hand, and there is no short for your long in this space. And I have personally benefited from this in my life. And I can tell you, when all else fails, having that insurance, it's no exaggeration to say it's a lifesaver, right? And nobody goes broke taking profits. And taking profits gives you the cash to move into the next big opportunity, or or to buy the dip when the time comes. Sorry, okay. Bit of a rant there, but there's so much emotion and angst out there. But we've seen all of this before. We know what to do in this case if we just have the discipline to follow what we know works. If you are convinced that this is just, a shoulder before the head, that we're about to go off into the blow off top phase of this market, then if that was me, if I believe that, like the next move is imminent and it's way up, woohoo, to the moon. If that's what I believed, I would absolutely focus on the majors, because that's where the new money coming in, not to say dumb money, but the Johnny come latelys, they're going to Google what's a gold company, and who they're going to find, right? Or what's the big silver, what's a silver company, right? Who they're going to find. That's why Doug Casey called these go-to companies. I think the go-to companies get there first. And if we get this huge surge, never mind what we just saw, but a bigger hockey stick, 10,000 gold, right? 200 silver, whatever. And then we get the other side of that peak. There may not be time for it to trickle down to the developers and the juniors, but the go-to companies will move, and they'll move, with gusto. So if that was my outlook, that's how I would play that. Personally, that's not how I see things. I think that I had been before, honestly, before 5,000, since 4,000 plus, I've been thinking that it was time for some correction and consolidation, like we saw at 2,000 and 3,000. And in my view, that's healthy, right? Shakes out the weak hands. You build a base, and then you move on up based on the fundamentals. You keep going. So, okay, it was a little bit more exciting and more energetic than I thought. But if that's where we are now, I think that's great. That's healthy. Again, it shakes out the weak hands, sets a base before the next move higher. And based on my fundamental view, that fits, right? Has the money printer stopped going burr? No. Have the central banks stopped buying gold? No. Has the world, suddenly embraced peace? Has Russia stopped bombing Ukraine? Is the Middle East completely settled? No, right? None of these factors. And it's very funny. I just saw some guy on Bloomberg talking about how the debasement trade is new. It's only a year old. Like, we've been talking about debasement since 1971. But that tells you how the mainstream, the Johnny come latelys, come to this, and they have no context, but they're aware in a way that nobody really was aware or believed or cared about in 2011. So I do think circumstances are different. My personal outlook is that we're in a consolidation phase, and I do think the next major move is likely to be higher, not lower. But that consolidation could be substantial. From 5,000 plus or minus 20%. That's $1,000. $1,000 swings is just 20%, but $1,000 swings will certainly, scare a lot of people and create a lot of opportunities in the stocks, which will add leverage to those swings.
Right. It's a very good answer, Lobo. Thank you for that. Just before we leave this precious metals topic, I would love to ask you about central banks buying. Would you, Lobo, agree with the statement that as the price of the commodity goes higher, that means that the demand from central banks will decline simply because it takes more fiat currency to buy that single ounce? So in theory, that demand should begin to decline in the future.
No. Let's say that, there'll be like margin compression there on the buying. If you're a central bank and you've got marching orders to buy, I doubt they have marching orders to buy a certain number of ounces per month. I doubt they have a dollar amount either. Like, they're not stupid. Or maybe, Doug Casey famously said that central bankers were morons who dress well, but that was in the days where they kept selling the stuff. Maybe it's a new generation of central bankers. But obviously, if you're accumulating, you're going to watch for volatility. You're gonna buy on the dips. And in fact, I'm not ready to go there. There's lithium in particular. There's a lot of lithium. It is not rare. I mean, it's right after hydrogen on the periodic table of the elements. And okay, economic concentrations versus abundance is a different thing. But you've got SQM and Albemarle and the Chinese. They've got projects. They're just waiting for higher prices. So this, unlike what we were just talking about with normally in mining, there's a moat and it takes years for competition for high prices to cure high prices. In lithium in particular, there's lithium ready to come to the market just like that. So high prices or higher prices, I think, would have an immediate countervailing effect. So back to your question, this leaves me with copper and uranium. When I'm thinking about, well, okay, where do I diversify, in addition to by the way, when I say take profits, that doesn't mean sell everything. if I've got a triple on something, a silver play, and I sell half, I've got 150% guaranteed profit money back in my hand, and I've got 150% more money in the play than I started with. Right? That's not abandoning the speculation. But anyway, I've taken some profits. I'm looking where to rotate, and copper and uranium are very much high on my list, if not top of my list. And both of them are absolutely essential. Neither of them is an AI play. Neither of them is completely about electric cars, though both of them are helped by both of those narratives. I see those as tailwinds on top of already, profoundly skewed fundamentals of demand increasing anyway. I mean, we call it Dr. Copper for a reason and have for decades before anybody even talked about AI or EVs. So that's and the supply is constrained. The big discoveries that are necessary to keep this going, they're just not happening fast enough, or even at all lately. And political risk is huge, especially for the kind of mega project that makes a difference for something like copper. A small little high grade mine might be a sweet little thing, but it's not going to move the market, right? The kind of major copper mines that we need, those are very rare. They're very hard to permit. They tend to turn entire mountain ranges into holes in the ground, and not everybody likes that, right? This is difficult. So major moat, absolutely can't replace it. Necessity for the fundamental commodities. And yes, I know that, someday thorium might replace uranium, but that's been sort of like fusion, right? Every year it's 5 years from now. that goalpost keeps moving. So I'm not worried about thorium. I'm not worried about fusion. I'm not worried about aluminum replacing copper. In fact, they're starting to replace silver with copper in some solar panels. But anyway, huge baked in the cake demand growth, on top of which the data centers and the EVs only add more. And supply constraints that are very, very difficult to address. And the discoveries aren't even happening fast enough. That's in copper more than uranium. There is more uranium out there that at the right level will come to market. But again, the moat takes years. I like them both. The main difference I see between them, Vladislav, is that there's no copper reactor that could melt down and scare the whole market out of copper. So I like them both. Maybe uranium, a little bit better opportunities in the moment. I see better buying opportunities in uranium space than copper, but copper is the safer speculation. I'm not too worried about uranium. Actually, I don't lose any sleep about nuclear accidents. Really, in the entire history of civilian nuclear energy, there's been one, Chernobyl, because 3 Mile Island was a nothing burger and Fukushima was a tsunami. There's Chernobyl, and that was arguably more about Soviet stupidity than nuclear engineering. And we've learned from that. So I really don't worry about this, but I think it's irresponsible to tell people, that uranium is an interesting basis for speculation without mentioning that it is one that could literally melt down on us in the worst case scenario.